Hello and welcome back to All Things Money. My name is David Blain. I'm your host for the show today. During today's show, we're taking a look at some of the immutable laws of investing. I don't think we'll get through all seven, but I've laid out 7 laws of investing that I think every investor would be wise to behold. These are sort of value-oriented principles. They apply to both bonds, stocks, real estate, any type of asset that you may be investing in. I think these apply to. A lot of my examples relate to the bond and stock market simply because we have a lot of reliable data. It's some of the most analyzed data that we have, and we're able to draw some reasonably accurate conclusions of it. A lot of these, if you're looking for further research, Google Benjamin Graham, security analysis, sort of the father of value investing. We like to follow the principles of value investing. Over the long term, it's where most of the money is made. In the short term, there are trends that develop in the market, and assets can become overvalued, and you can make money using what's called trend following as opposed to value investing. But it's very important when trends start to reach a peak and start to reverse, they can come down quite hard. And so over the long term, if you're looking at long-term planning, we like to look at value concepts. As I mentioned in the previous segment, if you look at the valuation, if you're starting at a point in time and you want to get the best predictor of what your return will be around 10 years in the future, if you look at the PE of the market, it's a perfect stair step down from the cheapest to the most expensive. When you buy the market at the cheapest, you're going to get the highest return, almost 11% compounded per year when the PE has been an average of 8.6. When the PE has been an average of 24.6, which is the most expensive 20% of the market, the 10-year return has been 24.6. Now, as of December 31st, 2010, the earnings of the S&P 500, the price divided by the average 10-year earnings was 22.4. So we are between the almost to the most expensive 20%. So what does this mean? It means that over the next decade, once again, we would not expect the returns to the equity markets to be very high. Probably on the order of somewhere between 2 to 5%. Now, does this mean that there aren't going to be times like last year where you can make 20% in a year? No, this is an average that if you're looking long term, you're saving for retirement, or you're looking to fund an endowment or a new wing on a hospital or something, and you're trying to gauge, what the returns of the capital markets may or may not be. My suggestion would be to look at the PE today. There are other factors involved we'll get into in another show that have to do with inflation. Inflation is the other big determinant of your returns. But for today, we're just talking about this concept of margin of safety. And today, in the U.S. market that we're focusing on today, there's not a big margin of safety. That's the point of this whole thing, is that there's not a big margin of safety. It doesn't mean that the market won't continue to go up. It just means that if we look back historically from a starting point of a PE of 22 where we are today, that the subsequent 10-year returns have not been that great. And so it tends to favor investors that are a little bit more nimble. When the market starts getting overvalued, you may want to think about taking some money off the table, taking some profits. And we'll get into that. One of our other things we'll talk about is what I call wait for the fat pitch. And in order to swing at the fat pitch, you have to have some cash. So we'll talk about that in a little bit. Some other supporting things. A lot of this long-term PE data comes from Robert Shiller, who's at the Yale School of Management. He does a lot of work on long-term PE work going back to 1880. When the S&P 500 PE is above 16, the average gain per year has been 0.1% since 1880. When it's been below 13.5, it's been 4.3%. Now these are inflation adjusted numbers that Shiller likes, the inflation adjusted PE. So it measures the growth of your real earnings power. So if you're used to hearing about 7, 8, 10% returns in the market, you got to reduce that by the amount of inflation. And so these are inflation adjusted. So when the market's the cheapest, you can expect to earn somewhere around 4% above inflation. When the PE's been above 16, essentially your gain above inflation has been nothing. And so that's the margin of safety. When investing, whether it be stocks or bonds, make sure that you understand the value of what you're purchasing and that you have some sort of valuation estimate. As I mentioned, the Shiller PE is one estimate. The Graham-Dodd PE, which is the current price over 10-year average earnings, is another good one to look at. That's what we were talking about during the first segment. 10-year average earnings is a good estimate to look at valuation over the long term. As we look around the world, we find somewhat similar stories. I think there are some markets, emerging markets, some of the PEs are not quite as robust as in the U.S., but your developed markets, the PEs are still very robust. The bond market seems to be overvalued when we look at the inflation rate, the real yield on bonds. I tend to think, especially U.S. Treasuries, that they're overvalued. And so what is one to do? Well, you can always raise cash, and we tend to keep the cash to a minimum. We're going to run into a break here, so let's hold off on that. When we come back, we'll talk a little bit about maybe what you should look at doing. So for All Things Money, I'm David Blain, and we'll take a break and be right back after a few minutes.